Understanding the symbiosis. Strong and simple framework versus Basel. The banking industry is a complex landscape, requiring a deep understanding of multifaceted regulations and frameworks. It's not just about grasping the regulations themselves, but also comprehending how they interact with one another to form a cohesive regulatory environment. Two key components in the UK banking sector are the strong and simple framework and the Basel regulations, particularly Basel 3.1. Let's explore the symbiotic relationship between these two regulatory elements and what it means for the future of the UK's banking industry. Basel regulations, the regulatory underpinning. The Basel regulations are internationally recognized banking regulations established by the Basel Committee on Banking Supervision. Their goal is to ensure sound and conservative financial practices by setting minimum standards for capital adequacy, stress testing, and market liquidity risk. Banks are required to maintain a certain level of capital to safeguard the financial system against economic downturns. Basel 3.1, the most recent adaptation, aims to refine and strengthen the measures introduced in Basel 3. Strong and simple framework, a UK perspective. In contrast to the broad-reaching and global scope of Basel regulations, the strong and simple framework is a regulatory regime designed by the Prudential Regulation Authority, PRA, specifically for smaller banks and building societies in the UK. Its purpose is to simplify and optimize the regulatory requirements for non-systemically important institutions, fostering competition, innovation, stability, and safety. The intricate balance, Basel and strong and simple. The interplay between Basel and the strong and simple framework is where the real intrigue lies. While both frameworks strive for the same objective of a safe and sound financial system, their approaches differ significantly. Basel regulations are intended for universal application, covering both large and small financial institutions. On the other hand, the strong and simple regime introduces proportionality, tailored specifically to the needs of smaller institutions. The PRA estimates that approximately 30 banks and 33 building societies would be eligible for the strong and simple regime. Implementation timelines, a race against time. The UK has set an implementation date for Basel 3.1 of the 1st of July 2025, having delayed the initial implementation date by 6 months. In contrast, the strong and simple regime plans to implement its initial phase in the second half of 2024. This staggered timeline presents smaller financial institutions with a crucial decision. They can initially comply with Basel 3.1 and later transition to the strong and simple regime, or they could adopt a transitional capital regime, TCR, and directly embrace the strong and simple framework once it is finalized. This decision has practical implications in terms of capital requirements and operational disruptions. Capital requirements and liquidity ratios, a delicate balance. Understanding the capital implications is paramount. Basel 3.1 mandates banks to maintain specific levels of capital adequacy and liquidity ratios, such as the Net Stable Funding Ratio, NSFR. The strong and simple regime proposes a new metric called the Retail Deposit Ratio, RDR, specifically designed to gauge the stability of retail funding. Want to learn more? Claire Trithel on LinkedIn